Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance and the course code for this subject is BS 151. This is lecture number 24 and the topic for today's discussion is types of financial statements and its uses. The outline of this lecture comprises of the two agenda. Number first is uses of financial statement with respect to the external and internal perspective. And then we shall discuss the two primary types of financial statements. Basically, there are four types of financial statements, but this lecture will cover the primary two of them particularly. So let us discuss the first agenda, the examples of external uses of statement analysis, why a financial statement analysis is important with respect to the external uses. Number first is the trade creditors, who are actually the debtors of the company, or we can say debt providers for the company. These are known as the financial bodies or different depository institutions which sanction loan to the business organization. Therefore, their primary emphasis is on to check out the liquidity of the firm before sanctioning loan to that particular organization. So once again, I must explain that the trade creditors basically focus on the liquidity of the firm. So therefore, they are in need of a good financial statement of the firm because their stake is going to be involved in the business organization which is looking for loan or debt financing. The second one is bondholders. Why the investors would like to purchase the bonds of a particular company, and these bondholders are also the creditors for a company, and their focus and emphasis is on the long-term cash flow of the firm. Since the bondholder will occupy the bond of the company for more than 1 or 2 years, and similarly if those are strategic in nature, then the bondholders will be looking to invest their money into the firm for at least 5 to 10 years. Therefore, their primary focus is on the long-term cash flow ability of the firm or the organization which is actually issuing these bonds. Basically, these two are our debt instruments, or debt instruments provider, debt financing providers rather, I must say. And the last one is shareholders. Why shareholders are interested in the financial statement analysis of a company? Definitely, the shareholders invest their money into the stock of a company for the purpose of earning profit from that company's shares. So the primary focus of the shareholder is on the profitability and as well as long-term health, financial health of the company, because they are going to receive certain amount as dividend and as well as price appreciation in the stock prices. So the external uses of financial statement is with respect to trade creditors who are going to give loan to the firm, bondholder who are going to invest their money on long-term basis at a fixed interest rate, and third, shareholders who are primarily interested in the profitability of the company so that they may realize greater amount of revenue or profit. Now let us discuss the examples of internal uses of financial statements. The first one is that the internal management is primarily interested to plan for the future investment opportunities. The focus on assessing the current financial position and evaluating the potentials for firm's opportunity. So basically, the assessment of the financial matters inside the organization by the top management is to plan for the future business investment opportunities. And from where they are going to get this data? Definitely from the study and analysis of financial statements of the company. Basically, company has 4 different types of financial statement named as balance sheet, income statement, statement of cash flow, and the owner's equity statement. However, the emphasis of this lecture will be on the discussion of balance sheet and income statement. The second emphasis of the internal management is to control function, like focus on return on investment for various assets and the asset efficiency. So in order to utilize the company's assets in a better way and to have a solid control on the firm's return on investment and return on assets, and as well as total asset turnover, they are interested to analyze the financial statement of the company. And third emphasis or use of the internal statement analysis is to focus on understanding how suppliers of fund analyze the firm. Suppliers of funds, who are the supplier of fund? In my previous slide, we have explained that there could be 3 basic sources or supplier of financing. We can get the financing from trade creditors, like taking loan from a banking organization. We can issue the bonds to the general public or investors. So therefore, bondholders can also invest their money at the rate of fixed interest rate into the organization. And third one is equity financing, that is to issue shares of the company which the shareholders are going to purchase and invest their money in order to share the profit and loss of the company. So understanding means focus of understanding how the suppliers of funds actually analyze the fund. If the suppliers are satisfied with the performance and financial health of the company, they will sanction loan or invest their money into the company. However, when the financial health and liquidity is a problem for a company, they are not going to invest or sanction loan to the firm which is looking to finance by utilizing the debt and as well as equity instruments. As previously discussed, that there are 4 basic types of financial statements. Out of those 4 statements, this lecture will address the first 2, which are balance sheet and income statement. So what is a balance sheet? A balance sheet is a summary of financial position at a given date that shows total assets are equal to the total liability and owner equity. As the name states, that it has a balancing equation which is known as accounting equation, that total assets of the company must always be equal to the total liabilities. These liabilities includes trade creditors, which are notes payable and account payable, and as well as the bond holders as well, plus the owner's equity, the amount of share capital invested by different investors. So all the time this statement must be in a balancing position, and if this equation is not in a balancing mode, then definitely you might have made certain mistake while constructing balance sheet. And the second very much important financial statement is the income statement, because the primary motive of any business organization is to earn profit. So therefore the income statement is really crucial to be made by the financial manager or any registered organization, so that they must know what they have earned in a particular time period, either their firm is going in profit or in loss. So what is the financial income statement? It is a summaries of firm's revenue and expenses over a specified period, ending with net income or net loss for the period. Either the firm will have net income at the end of the operations for a specific period. Usually this income statement covers 1 year of time period, or at the end of the year the company may have loss. Let us discuss both of these statements one by one. Here is an example of Basket Wonder company balance sheet, and these figures and amounts are in thousands. In 1000 means you are going to add up 3 more zeros at the right side of given value. Like this is cash, and cash equivalent is $90 mentioned over here because of the space limitation. So we have avoided or omitted 3 zeros in front of 90. It means that this is actually $90,000. So when the values are written in 9,000, then you are required to add up 3 more zero at the right side of given figure. And similarly, these 3 zero will add up to the rest of the values, right from top to the bottom. So this is a balance sheet, and its left hand side is actually telling us the assets or economic resources owned by the business. This balance sheet has current and fixed assets, and according to the rules we have to follow the order of liquidity. The order of liquidity says to write up that asset on the top position, which is either in cash or in cash form. Secondly, you are going to write down that asset which is going to be converted into cash at a faster way, and as well as near to the original amount. Like account receivable, company might have given certain amount as loan, or product or services might have been delivered to the certain customers who had promised to pay out that amount in future. So usually account receivables are convertible into cash within 30 days of time period. This A is basically representing how the funds stand on a specific date, as the definition says or told. This C is referring towards the point number C at the right hand side, that account receivable are accounts owed by the customer. Customers are supposed to pay out to the basket vendor within 30 days. Inventories are the stocks that might be finished and as well as raw material. Then prepaid expenses. What are prepaid expenses? Point number D explain that. Future expenses item which are already paid. For example, the company might have paid the advance rent of 6 months, so that is known as prepaid expense. And similarly, accumulated tax prepay, advance tax payment or accumulation, which is $10,000. After summing them up, we have current assets of 1,195, and then the time comes to write down the fixed assets which are not convertible into cash within one time period, rather they are going to generate revenue for the company over the number of years. So point number F refers towards the explanation of fixed asset, which is the original amount paid for this fixed asset less accumulated depreciation, the amount what has been depreciated on from the fixed asset, that is the accumulated deduction for wear and tear of fixed assets. Adjusting both fixed and less accumulated depreciation, we are left with $701,000 of net fixed asset. Then this is our investment in long-term securities, like our company might have invested in the bonds and shares of another company, so those are known as long-term investments, which is 50,000, and other assets in long-term natures like in the investment in the property and land, etc., which is $223,000. So in total, company has 2,169, and then values are in thousands. So we can say that $2.169 million of worth assets company possesses. This is point number B, refers to what the basket vendor own on a specific date. So left hand side is actually explaining the assets of the company, and the right hand side is the sources of company from where the company has actually purchased these different kinds of assets, and those sources are either debt financing or equity financing. The debt financing is actually the liability, and equity financing is issuance of shares. Now we are discussing the liability side, which is actually written at the right hand side of a balance sheet. So we are required to mention the liabilities of the company first, starting with notes payable. which is mandatory to be paid out, since we have made or written down an agreement with the body from where we have obtained this loan. However, the account payable, which is supposed to be paid out within 30 days, and it is referring towards point number C, like owed to supplier for goods and services. Similarly, accrued taxes, which have been accrued but not yet paid, refers to the unpaid wages, salaries, and taxes to the government. These are our current liabilities, because current liabilities means all those liabilities which are supposed to be paid out within 1 year of time period. And long-term debt usually belongs to bondholder or a long-term loan obtained from a bank, which is $530,000. And this loan is supposed to be paid out and its maturity is greater than 1 year of time period. As mentioned in point number F, these are the debts which are payable and their maturity is greater than 1 year of time period. Then we are required to mention the shareholders equity section. It starts with the common stock, and this is one par value, and the point is G, referring towards the original investment of the investors. This is the stock or share what the investor have purchased in this company, which is Basket Wanderers. Then we are going to write the additional paid in capital. Additional paid in capital is actually the amount paid by the investor which is in excess to the par value of shares. And finally, we have a retained earning. This retained earning belongs to Basket Wanderers' previous years of net income, which was retained by the company and not paid out in the form of dividends to the investor. This is also part of owner equity. You are required to add up all these three and you will get the total equity portion of this Basket Wanderers 2007 balance sheet. Now at the final step, you are going to accumulate both liabilities and owner equities. Therefore, you are supposed to add up 500 with the total equity and you will get the final answer, which is $2,169,000, which is same as the total assets in our previous slide. Hence, the statement or the accounting statement has been proved true, that total assets are equal to total liabilities and total owner's equity. And these are some of the points which I have explained and which are related and pertinent with the liability sections. Now let us discuss another financial statement, which is income statement. And the narration looks like Basket Wanderers statement of earning. We can also call it as a statement of earning, and values are once again in thousand. However, we are not going to discuss these in thousand over here because these create confusion, and let's assume that these are the original figure or numerical values. So the way is to Basket Wanderers statement of earning for the year ending December 31st 2007. This A is referring towards the point number A. It measures the profitability over a period of time. The method to make income statement is to write down first the total accumulated net sale of the company, which is 2,211. Then in the next step, you are going to minus cost of goods sold from net sale in order to reach at the gross profit of the company. This B refers to received or receivable from the customer amount. So if after subtracting cost of goods sold from net sale, you reached at gross profit, in the next step you are going to minus selling, general and administrative expenses of the company. What type of expenses these are? It has been cleared that these are the sales commission, advertisement expenditures, or the officer and employee salaries which the company is going to pay out them. In this step, we are going to minus the selling, general and administrative expenses, and we come up with earning before interest and tax and depreciation as well, amortization. So here is only interest and tax is left over. The remaining administrative expenses have been deducted in the previous step. So now we are in a position that we have realized the operating income, which is also referred as earning before interest and tax. After this, we are going to minus the interest expense to the bank or bond holders, and the remaining amount will be called as earning before tax, which is 151. After this deduction, we are going to minus the income taxes, because we are going to pay out taxes to the government on the amount what we have earned, but it should be applicable on earning before taxes amount. After applying certain percentage of tax on 151, which come up with $60 of tax, we are left with earning after tax, which is $91. But actually this 91 is in thousands, so $91,000 is the earning after tax for this company. After this deduction, if the company is a public limited company and that board of director have decided to pay out dividend to the shareholders, then the cash dividend will be deducted in the next step. So here we got the another idea that cash dividend is paid out from income statement or net earning after taxes, which is $38,000, and the final amount left over with the company is $53,000, since these values are in thousands. And this leftover amount is known as increase in the retained earning. This earning after tax was the actual earning attributable to the shareholder. However, the company board of directors have decided to pay out certain amount of earning after tax as dividend and to retain the remaining amount for the next year project and investment opportunities. So when the prospect of the companies are high and there are bright investment opportunities available, the board of directors normally decide to retain maximum amount of earnings so that they can rely less upon the bond holders or debt financing, and as well as they don't rely on the external financing. So this is also known as the sources of internal financing, what the company has retained inside, which is $53,000. So this was all about the two important financial statements and its uses with respect to internal and external perspective. Thank you very much for listening to this lecture. If you have any question, you can ask. Good luck for the day. Allah Hafiz.